Good morning. This is Bloomberg Daybreak Europe. I'm Jemana Bersachi in Dubai, and these are the stories that set your agenda. Global stock sell-off. Asian equities set for the biggest loss in 2 years after weak data on the U.S. economy. Treasuries gain for a 7th straight day ahead of today's jobs report. Intel plummets as much as 19% after releasing a barrage of bad news, while Amazon tumbles on its plan for increased AI spending. We'll bring you the details along with the latest from Apple. And the Bank of England cuts rates for the first time in over 4 years in a narrow 5-4 decision. Well, good morning, everybody, and welcome to Daybreak Europe. Let's get you up to speed on some of these markets because we are seeing a major pullback for risk assets in the last 24 hours. The worst session for Asian stocks in over 2 years. We'll talk more about that shortly with Avril. But as you can see, as we get into the European session, we've got Euro Stoxx futures pointing to another negative open. So down about 0.9%. S&P futures leaning negative as well, down 0.8%. NASDAQ down 1.4%, building on from losses yesterday with the NASDAQ closing more than 2.3% lower. A lot of moves also to digest in after hours, the likes of Intel down double digits, ARM as well. So many of these tech stocks that have reported this week have been disappointing with their earnings, and we will discuss that more on the show. But it is not just equities that have seen major moves. Let's switch the board and take a look at some of the other assets that we've been monitoring very closely. Here you're going to take a look at the 10-year yield in the U.S. Look at where it's trading. It's got a 3 handle. We have broken through 4%. 3.96 is where we are at, down about 10 basis points. And this as the market has started to divert its attention away from just interest rate cuts to serious concerns about the global economy and the data that's coming through. The ISM manufacturing number that came through yesterday, a big driver for yields moving lower. And all eyes today will be on that NFP print and whether or not we'll see further weakness in the labor market. Quick, just one comment on the Bank of England. They did cut rates yesterday, but also signaled they're going to go slowly for future interest rate decisions. The market's pricing in a little more than 30 basis points of rate cuts for the rest of the year. But let's talk more about how these Asian markets are faring. Avril is in Singapore, and big moves in those Japanese indices, Avril.
Absolutely. Look at the 5% plummet we're seeing on the Nikkei, on the topics. This is fast becoming the week that was. And this is saying a lot given the turbulence we've been seeing recently. Now we're seeing markets really repricing, adjusting to those concerns that the Federal Reserve is behind the curve given the U.S. data overnight. Can the U.S. economy wait until September for rate cuts? And then, of course, those tech earnings, Intel, Amazon missing on the revenue forecast. We have the China woes coming through from Apple, the infotech sector declining 5%, steepest bleed since March of 2020. And then, of course, this is also coming against the backdrop of a relatively strong Japanese currency, still hovering with strength around the 149 level, even though it's giving up some of the gains of the past 3 sessions. So you can see the bleed really coming through in Japan. Flip the board. As I talk about the yen, worth also keeping in mind some of the other currencies in the APEC region that should technically benefit from these Fed rate cut expectations. But you're still seeing the bleed in the won, in the Taiwan dollar amid the stock market outflows. Dollar China also in focus. It seems like the Chinese central bank is trying to narrow the spread between the yuan fix and the spot rate. And this is something that we've also seen in past bouts of market turbulence between 2008 and 2010. So really interesting dynamic. And this comes on a day where we heard from the PBOC advisor in a rare criticism of China's economic policies. That really shows you how dire the situation is in China. Flip the board. This is all makings for the China bond rally that is continuing. It is on track, China bonds, for its best 2 weeks this year. We're seeing the yield on the Chinese 10-year hitting the 2.12% level. Flip the board again. One more chart to show you the extent of the bleed in Japanese equities today. The losses you're seeing today, taking the 2-day decline to 8%, worst decline in years, hitting the 200-day moving average, oversold conditions. All this as that repricing, recalibration goes on to the difference in the macro side of things, Jumana.
Yeah. Well, it is a day of superlatives, big moves everywhere. April, thanks so much for the overview of what's happening in Asian markets. Let's turn back to tech stocks. Nasdaq futures are slumping after Intel and Amazon earnings disappointed investors. Amazon's profit forecast for the current quarter missed Wall Street projections. And during the earnings call, the CEO Andy Jassy stressed that they are bullish on the medium to long-term AI growth.
We remain very bullish on the medium to long-term impact of AI in every business we know and can imagine. The progress may not be one straight line for companies. Generative AI especially is quite iterative, and companies have to build muscle around the best way to solve actual customer problems.
Let's get out to Matt Bloxham from Bloomberg Intelligence, who joins us now. Well, AI was always going to be a big theme on these earnings calls. And even though we heard from Andy Jassy talking about their spending plans for artificial intelligence, it didn't satisfy what investors were looking for.
No, that's right. I mean, actually, in the quarter, Amazon Web Services did much better in terms of revenue growth than people thought. So it grew 19% year over year, and people were looking for about 17%. So that was encouraging. But as we just heard there, the AI opportunity is really a mid to long term play, and we're not seeing really significant shifts in revenue growth in the short term, but we are seeing a lot of capital spending to create the AI technology platforms these companies need to develop. And they guided to higher capex in the second half of the year versus the first half. There's a very familiar theme that we're seeing across all these big tech companies, that they're really confident in the AI story, but it's very much a patience game for investors that have to trust them that the money they're spending right now is going to be worth it in the long term. And on top of that, for Amazon, online consumer spending is going through a bit of a weaker period, so that part of the business isn't quite living up to market expectations.
Yeah. Another stock that is not living up to market expectation is Intel. I was just taking a look at where the stock has been trading and how it's done over the course of the year. It's almost halved over the course of 2024. This is a year where there's been so much excitement about chip makers, and yet Intel can't seem to get a bid. The results yesterday announcing over 15,000 job cuts. So the story there seems to be quite bleak. Tell us more.
Yeah, it does. I mean, actually, the results in the quarter weren't too far from what the market was expecting, but the kind of forward guidance, particularly on revenue, was way short of market expectations. And we'll see Intel, very much the kind of legacy chip maker, really being crowded out of the AI market by people like NVIDIA. And NVIDIA's even developing technology that may threaten Intel's core business. And I think we're seeing those kind of dynamics play out for Intel. They obviously are investing significantly to try to get into the AI arena, but it's coming through at a much slower pace than people thought. So they're having to kind of resize the business to reflect the reality of the trading environment they've got. So yeah, challenging times for Intel for sure.
Yeah, well, one of the other major stocks in Magnificent Seven that we need to talk about is Apple. So Apple did report better than expected revenue growth in the quarter ending in June, but sales in China fell 6.5%. The CEO, Tim Cook, talked more about the challenges from China during the company's earnings call. Let's take a listen.
During the quarter, I should say also that iPad returned to growth in Greater China as it did around the world. And so we continue to be confident in the long-term opportunity in China. I don't know how every chapter of the book reads, but we're very confident in the long term.
Interesting to hear an American CEO talk up the prospects for the Chinese economy. What were the other takeaways from the Apple conference call?
Yeah, so perhaps the biggest one was the kind of forward guidance on revenue growth, so that they're expecting similar growth in the forward quarter to the quarter they just announced, was about 5% year-on-year growth, which is a bit better than the market expected. The market's been looking for about 4%, so that's encouraging. And yeah, to some degree, that comes from their expectations around the iPhone 16 launch, which will come in September, and the new Apple Intelligence or AI features that will be embedded in that, which they're saying they're confident will drive a fresh upgrade cycle amongst their user base. So that could drive revenue for iPhone. We saw a really big swing back into revenue growth for iPads, which was kind of expected, but encouraging to see that come through. So, I think overall, Apple is in a strong position. It's got a really good product lineup. I think the really big focus now is definitely going to be around the iPhone 16 launch and Apple Intelligence, and really quite how strong that upgrade cycle is going to be from those new features that come in.
Yeah. It's going to be a big one for investors. Matt, thank you so much for the overview of some of the major stocks that we've been watching in after hours. Matt Bloxham from Bloomberg Intelligence. Well, we have a busy day coming up today. Let's just get you up to speed on some of the highlights that you can watch out for. 12:15 p.m. UK time. Hugh Pill will be speaking. Of course, he is the Bank of England chief economist, coming on the heels of that interest rate cut out of the BOE yesterday, the first time they cut interest rates since 2020, though the signaling has been quite cautious about the prospect of further interest rate cuts. So watch out for any commentary on how Hugh Pill thinks the situation may evolve. And of course, the big event for U.S. investors as ever, NFP. Watch out for those U.S. jobs reports. The market is expecting a small decline from 201K print at the last number to 175,000 today. So we'll show a moderation. The jobs market. Also keep an eye out for that unemployment rate expected to hold steady at 4.1%. This, of course, as the Fed Chair Jerome Powell said earlier this week, that they're paying closer and closer attention to the state of the U.S. labor market. And then also we are going to be getting some more oil giant results. So keep an eye out for Exxon and Chevron earnings. This as we continue on with the earnings week. Over the course of the year, Exxon up 11%. And you can see, other stocks in the basket generally have been doing quite well on back of bigger hits on upstream, but some pressure coming through on their refining margins downstream. So watch out for those themes later on. All right, also coming up, two-year Treasury yields slide on soft economic data out of the U.S. We discuss rate cuts and recession risks next. And later this hour, the CEO of AXA joins us for an exclusive interview on earnings. We'll also discuss a deal to create one of Europe's largest money managers. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. The Treasury two-year yield fell to the lowest since May 2023. As traders ramp up dovish Fed wagers, it is not just the two-year yield, 10-year yield also breaking through 4%. Let's bring in our MLive strategist, Mark Cranfield. So a lot is at stake with the upcoming NFP print today. This following on from a very disappointing ISM manufacturing number yesterday. What's in store?
There's a lot at stake for Fed speakers as well. Now that the window has closed, they can come back to speaking over the next few days. They'll be trying not to fuel any more panic in financial markets. So we've had a very turbulent couple of days since the FOMC met this week. And you would have thought with a relatively dovish outlook that they gave that traders would be very happy. But the way the equity markets are going and this tremendous move in the Treasury market, as you say, the 10 years down to a 3% handle now, there's a sense that the markets are really suggesting not that the Fed is so much behind the curve, that they really need to get on with it and do a bigger rate cut. So what the job of the Fed speakers in the next few days will be to convince traders that the idea of a soft landing is still in place, that they can afford to take their time. They probably will lower rates in September, providing the data continues to move in the right direction. But they will really want to avoid the idea that they need to do a 50 basis points rate cut in September. That would just look like panic. And it would probably have the reverse effect to make markets even more nervous. So you'll probably hear Fed speakers trying to cool everybody down, say everything is fine, and that will be the message they'll be giving in the next few days.
Yeah, well, let's speak about messaging. The Bank of England governor says that interest rates will settle at above pre-COVID levels following the decision to ease. Our colleague Francine asked Andrew Bailey what officials need to see before they decide to cut rates again. Let's listen in.
Don't expect we're going back to zero, because zero was the product of huge global shocks, starting with the financial crisis and obviously COVID as well. I think to get to there, something really bad has to happen that we're not currently expecting. It will be lower than where we are today, but I think it's very clear that we're not going back to zero.
Well, it's certainly difficult to imagine any central bank going back to zero at this point in time with inflation levels sitting where they are. But Mark, the takeaway, I think, from the press conference yesterday and the commentary that the governor of the Bank of England delivered is that they're going to be cautious about further interest rate cuts. It's not a done deal that this is the beginning of an aggressive cutting cycle.
No, by no means. And although they'll be pleased with the way the inflation is going towards their target, the biggest factor for the Bank of England between now and the next couple of meetings really is the fiscal side of things. So they were caught out before. If you remember when Liz Truss was the Prime Minister, there was this horrible situation where there was some mismanagement in terms of the messaging from the Finance Ministry, and we had this huge sell-off in UK bonds. The Bank of England will be very wary of that. And the UK budget does not come until October. Now, the new Chancellor of the Exchequer, Miss Reeves, has been giving all the right messages. It sounds as though she's on top of things, that she's going to be prudent, and that she will be delivering a message through her budget, which is pleasing to the rating agencies. They don't need to worry about the UK. But the Bank of England, being cautious folk as they will want to actually see the details. They want to see it delivered in the right way, and they will be reluctant to lower interest rates again until they see exactly what the government delivers. And that's what traders are counting on. Traders are getting a bit overexcited and they think that the Bank of England will move earlier. They're probably going to be disappointed because they really want to be sure that they don't cut rates and then the fiscal situation deteriorates and they may even then have to say we have to go back to hiking again. No central bank wants to flip-flop on its messaging like that. So really, how the government delivers its fiscal plan is the absolute key. Of course, inflation needs to do the right thing, but more than anything, the UK government has to deliver as well.
Yeah, well, October is going to be key in that regard. MLife strategist Mark Cranfield, thank you. It is a big day for markets. We are keeping a close eye on some of these semiconductor stocks. Just to give you an update, SK Hynix has extended its losses now to 10%. We're seeing a broader sell-off for chip stocks in general, more broadly. But this, remember, there's a geopolitical story as well at play here, and the fact that we've been talking about U.S. thinking about restrictions on China's access to AI memory chips. One of the companies that is exposed to that is SK Hynix. So we continue to keep an eye on some of the moves going on in that space, down almost 10% in trading. But stocks in Asia are tanking today after soft U.S. data triggered fears of a recession. Two-year Treasury yields also dropped as traders brace for upcoming U.S. jobs numbers later today. Really happy to say that joining me now is Raffaella Tenconi, founder and managing director at ADA Economics. Raffaella, great to have you with us. Do you think that this market shakeout that we're seeing is investors coming around to the view that looking ahead, there are warning signs for the global economy?
Good morning. I'm delighted to be with you this morning. I think the current correction is a mixture of things. Certainly the beginning of the easing cycle by the large central banks and the fact that the labor markets are now evidently softening has created significantly more uncertainty going forward. But we still think that actually the risk of recession is really mild at this stage. And we see the market correction, especially around tech, to be a transitory event.
Yeah. Let me ask you about your outlook for data, because actually GDP surprised to the upside. Q2 U.S. GDP came in stronger than expectations. For most of Europe, apart from Germany, we also got an upward surprise. Where are the negative signals coming from if you look into the third quarter?
Yeah, you're exactly right. I mean, the Q2 GDP numbers were robust, both in the US and in the Eurozone. In the US, what we see is that the quality and the quantity of job creation has clearly diminished now for 6 months running. The number of unemployed created in the last 12 months has exceeded the number of new jobs created. So this is a clear leading signal in all of the business cycles that the unemployment rate is rising, and we expect it to hit 4.5% by early next year. So there is an adjustment, but it's much slower than normal.
Yeah, but at the same time, this is coinciding with the beginning of a global easing cycle. So to what extent do you think central banks can actually reduce the possibility of a recession because they are beginning to cut interest rates now?
It is definitely effective, right? Because if you begin to ease and you move from restrictive to neutral, then on margin, you'll be able to soften some of the pain in mortgages, some of the distressed companies, support credit at the consumer level. So that will help consumer confidence, 3 quarters down the line. So I think it is very important timing and magnitude. We are not in the camp that central banks are moving to a really loose stance. So this is an ongoing adjustment that the economy needs to go. But given that the labor market is softening, but not really collapsing, that's why I'm saying, recession risk really looks very minor at this stage.
Yeah, where do you think rates actually end up then, given what you just said?
So we see about 100 basis points cut overall by the Fed, 100 to 125 by the ECB, and up to 150 by the Bank of England. So roughly all three will have interest rates between 3.5% and 4% next year.
Perfect. Raffaella, thank you so much for giving us your forecast of the global economy and where you see rates going. Raffaella Tenconi, founder and managing director of 88 Economics. Well, also coming up, China currently dominates clean tech, but could a push to return manufacturing to the U.S. and EU change that? We'll discuss that next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Today's clean technology supply chains are dominated by China, but that may change if reshoring efforts in the West are successful. It started with electric vehicles, but how far could the wave of protectionism spread? Here to tell us more is Antoine Vanier-Jones, the head of trade and supply chains at Bloomberg NEF. Great to have you with us. Well, the U.S. hiked tariffs on Chinese EVs earlier this year. The EU followed suit shortly afterwards. Is it your expectation that tariffs are just going to be the new normal now?
Hi, thanks for having me. It's great to be here. Yeah, so recently what we've seen in Western governments, especially in the EU and the US, have been reacting to the perception that Chinese EVs are much more competitive than their own automakers and what's being offered there. And what we've seen is a rise in tariffs as a result. So, I mean, in May this year, the Biden administration raised already quite high tariffs to over 100% on Chinese EVs. The EU followed suit a couple of months later with the results of an anti-subsidy investigation, with tariffs set about half that level, but still very consequential for a part of the world with very low tariffs historically. And then just now we've really heard that Canada is coming to the end of a consultation and could also end up putting in place tariffs on Chinese EVs of its own. So this is a big shift, and we're seeing things move quite quickly.
Yeah, I mean, this does sound like a very big shift, but how much of an actual economic impact are these tariffs going to have?
Yeah, it's a really good question. So in the US, it is more for the future, where we don't really currently see that much in the way of EVs being exported from China to the US, so it's more preventative. In the EU, we are seeing more in the way of imports of Chinese EVs sort of gradually rise year on year, and that's worried policymakers. But then a lot of those automakers like BYD, for example, have quite high margins, 20 to 30% when they're selling into the EU. So when we're looking at tariffs set at the EU's level, for example, actually what might end up happening is Chinese EV makers can absorb those tariffs, continue to sell into the EU, and we just see higher costs for consumers who are keen to sort of switch to electrified vehicles.
Yeah, makes sense. Antoine, thank you so much for giving us an overview. That was Antoine Vanier-Jones, the head of trade and supply chains at BNEF. And if you'd like to hear more from BNEF's analysis, download the Switched On podcast on Apple, Spotify, or wherever you get your podcasts. Coming up, an exclusive interview with the CEO of AXA on the insurer's profit beat and a tie-up to create one of Europe's largest money managers. This is Bloomberg. Good morning. This is Bloomberg Daybreak Europe. I'm Jemana Bersetchi in Dubai, and these are the stories that set your agenda. Global stock sell-off. Asian equities set for the biggest loss in 2 years after weak data on the U.S. economy and disappointing tech earnings. Treasuries gain for a 7th straight day ahead of today's jobs report. Russia frees Wall Street Journal reporter Evan Gershkovich and others in the largest prisoner exchange with the West in decades.
Remember what I said? Alliances make a difference. We stepped up. They took a chance for us. It mattered a lot. So the ladies are home.
And BNP Paribas is in exclusive talks to buy AXA's asset management unit in a €5 billion deal. Our exclusive interview with the AXA CEO in just a few moments. All right, let's get you caught up to speed on some of these market moves because it is a heavy day for trading across equities. The pickup from Asia, very negative. Nikkei down almost 5% in the overnight session. This after a negative handover for Wall Street. Yesterday, the S&P ending the session down more than 1.4%. Nasdaq down more than 2.3% as we keep a close eye on both the macro data, ISM manufacturing disappointing to the downside as we head into that NFP print today. A lot of focus on the labor market signals that are coming through. But into the session, all of these futures, with the exception of the FTSE, are leaning towards the red. Nasdaq 100 pointing to another negative open of down 1.3% after some of those after-hours earnings came through, disappointing to the downside. We speak of the likes of Intel and Amazon. Other boards that we're watching out for today, fixed income, really big rally yesterday after those ISM numbers, disappointed to the downside in the U.S. You can see the 10-year yield has traded through 4% now. 3.96 is where we're at, another 1 basis point lower on the session as, again, investors start to price in more out of the Fed by the end of the year. And then Bank of England, they came forth with that rate cuts yesterday, very fine split, 5-4. And as you can see, we are continuing to see some downward pressure on the pound. It's down about 1% for the week, sitting at 127.27. Oil, keeping a close eye on that as well, still sitting above $80, but down for the week. Now, French insurer AXA is in talks to sell its asset management unit to BNP Paribas for €5.1 billion. The tie-up would create one of Europe's largest money managers. Yesterday, AXA beat estimates after reporting underlying profits of €4.24 billion for the first half of the year. So really happy to say that AXA Group CEO Thomas Buberl joins me now for an exclusive interview. Thomas, great to have you with us. Looks like you had a strong start to the year. Some of that pricing is coming through. Just to point out, your first half gross written premiums and other revenues have actually climbed 7.4%. So what do you point that strength down to?
Yeah, look, first of all, good morning. We're very happy with these numbers. 7% top-line growth is something that we haven't seen for a long time. And this is a very good start to our new plan. Obviously, insurance demand is very high in times of high uncertainty and in times of high demand to cover risks. And we are very well positioned as being one of the largest insurers for company in this world and being one of the largest in health and protection. And those are exactly the areas that are growing very well. And this is the result that you can see today.
And can you just give us a little bit more commentary about your property and casualty insurance business and what sort of pricing visibility you have into the second half of the year?
Look, prices continue to be very strong because obviously the risks around us are very strong. If you think about natural catastrophes, if you think about as well cyber risk, but also if you think about the need to find new solutions in a world that has become more complex. And this is the key driver for growth that we see. And so pricing momentum and demand momentum remains still very strong.
Yeah, talk to me about the other big announcement that came out yesterday as well. An exclusive negotiation agreement with BNP Paribas for the sale of AXA Investment Management. First of all, how did this deal come to be and what sort of an impact is it going to have on your top line?
Look, at AXA, we have a very strong desire to grow also in the life and savings business. And in order to be competitive and grow well in the life and savings business, you need to have an asset manager of significant size that has the product breadth and the expertise. AXA IM AXA Investment Management is a story at AXA of 30 years of great success. But when you look, is it big enough to really serve our needs? The answer is clearly no. And therefore, we have been looking for a partner that is like-minded and with whom we can create a strong European asset manager in order to really serve our growth ambitions well to the future. And this is exactly the deal you have seen with BNP. We've got a partner that is very like-minded. We have decided to enter into exclusive negotiations to sell, to really create this strong European asset manager.
What do you say to some of the analysts who are now pointing out that AXA, as a function of this deal, will become less diversified and perhaps more exposed to market moves?
I would say that they should better look at our numbers and see that this is not true, because when you look, the majority of our risk is so-called technical risks. So we're insuring natural catastrophes, we're insuring buildings, we're insuring people's health. This is very much decorrelated from market risks and financial risks. So the opposite is true. And obviously with this move to sell our asset management business, which represents, by the way, 5% of our earnings, we are focusing even more on insurance. And this has been the strategy over the last 8 years, making sure that we simplify the group, that we focus the group, and that we focus on our key areas where we want to be good. One is being a very strong insurer in Europe. Secondly, being one of the leading insurers for companies in the world.
I want to turn your attention to another event that happened on July the 19th. It's probably not going to fall into this quarter, but I'm curious to see the impact that that global cyber outage is going to have on the insurance payouts in the coming quarter.
So I think you're referring to the CrowdStrike event that we have seen a couple of weeks ago. That is obviously not hitting any of these accounts, but and this is something I guess that you will see going forward probably more often. When it comes to us, we will not be very concerned by this. I would estimate this loss to be below 100 million, which is something that we will be able to digest normally. But it is important that for these events, we have coverages, we help our customers, because I believe those events will come up more and more.
Yeah, so it's not just cyber events, but also we've been keeping a close track on climate events as well, and the fact that global warming continues to affect businesses materially, financially, economically, and they have to start provisioning for that. What role does AXA play in helping your customers navigate some of those climate concerns?
So you're absolutely right. Climate and climate catastrophes have really increased. And normally in the second half of the year, this is far more pronounced than in the first half of the year. Our role is very key in this, not only to help our customers when an event has happened, but also, and this is probably more and more coming, help our customers on the prevention side. If you look, for example, the very large hurricanes that have the same trajectory over many years, you see that costs are actually coming down, which means that prevention does work. And we are very engaged, in particular with our subsidiary AXA Climate, to help our customers to prevent the loss from these climate disasters. And this is our key role going forward, not only in climate, but also in other areas. If you think about health insurance, how can we help our customers to avoid the claim of tomorrow?
Yeah, very clear. Thomas, thank you so much for your time this morning. Thomas Buberl, the AXA CEO. Now, the Wall Street Journal reporter Evan Gershkovich is back in the U.S. after being freed in the biggest prisoner exchange between Russia and the West in decades. Gershkovich was released along with former Marine Paul Whelan and another journalist with dual Russian and U.S. citizenship. The president and vice president greeted them as they arrived at Joint Base Andrews.
Toughest call on this one for other countries, because I asked them to do some things that were against their immediate self-interest, and really very difficult for them to do, particularly Germany and Slovenia. Slovenia came in at the last minute, and I tell you what, the chancellor was incredible. I don't buy this idea that you can let these people rot in jail because other people may be captured.
This is just an extraordinary testament to the importance of having a president who understands the power of diplomacy.
Well, comments from both the president and the vice president there. To talk more about this, Bloomberg's Greg Sullivan joins me now. Fantastic sequence of events, very heartwarming, poignant moments as seeing the political prisoners land back in the U.S. How long has this been in the works for?
Well, obviously, this has been in the works for a long time. It's a very complex. The size and scope of this deal is something we haven't seen in decades. In the case of a prisoner like Paul Whelan, who's been held for several years, the administration has been trying. They even tried when in 2022 when Brittany Griner was exchanged for the notorious arms dealer Victor Bout. In case of Gershkovich, we know that this has been going on for a while. In fact, in June, Putin said that there had been contacts between the two administrations. So this has been in the works for a while to bring in all the partners and make something like this very possible.
Yeah, it's really interesting. We've got some great stories up on the terminal about all of the diplomacy that was going on between the U.S. and China, getting Scholz on board as well. And, of course, this is a major diplomatic victory, a political victory for President Biden. But there was an exchange of political prisoners. And so how is it being perceived from the other side? Surely President Putin is looking to capitalize on this as well.
Absolutely. For Putin, this is definitely a victory. There's no doubt about it. He's getting a prize that he has long sought. He wanted Vadim Krasikov to come home. He wanted to be able to send a signal to his service agents out in the field that they will do whatever it takes to bring them home. And he greeted the prisoners that returned to Russia with smiles. He's very happy about this. So, yes, this is being cast as a victory in Russia.
A victory for both. But most importantly, the U.S. Journalists are back home again. Greg Sullivan, thank you so much for the latest on this very important world story. And later today, we will be speaking with the former UK ambassador to Russia, Laurie Bristow. Don't miss that interview at 9:30 a.m. London time. Well, coming up next, we'll be speaking with the CFO of Erste Bank on the Austrian bank's latest earnings. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now to some other stories making the news. President Biden has spoken with Israeli Prime Minister Benjamin Netanyahu, promising new defensive U.S. military deployments. That's as Israel faces threats after the assassinations of leaders from Iran-backed Hamas and Hezbollah. Iran's supreme leader prayed over the body of Hamas political leader Ismail Haniyeh on Thursday after his killing a day earlier in Tehran. While in Beirut, a similar procession was held for a Hezbollah commander killed in the Lebanese capital, Beirut. Now, the U.S. Secretary of State says Venezuelan opposition candidate Edmundo Gonzalez won the most votes in last weekend's disputed presidential elections. Antony Blinken says there is no evidence supporting the victory declaration of President Nicolas Maduro. Opposition leader Maria Corina Machado is calling for nationwide demonstrations on Saturday. And ING, the parent company of British Airways, is abandoning its plan to buy Air Europa. It's the second time it's tried unsuccessfully to take over the Spanish carrier after finding that regulatory opposition did not provide a viable path to completing the deal. IAG will pay 50 million euros as a termination fee and will be left holding a 20% minority stake in Air Europa. Well, the earnings continue to come thick and fast this morning. Let me just bring you some of the headlines from Erste Group. We're going to be speaking to the CFO shortly. But some of the major takeaways, the group is targeting a record €3 per share for the dividend. They see a stable financial year net interest income. Second quarter net interest margin came in at 2.43%. Operating expenses growth of around 5%. They see financial year cost-to-income ratio below about 50%. But just to give you the top-line figures as well, the second quarter revenue came in higher than expectations at 2.73 billion euros versus estimates of 2.69. And then on the bottom line, second quarter net income came in at 846 million versus 767.6 1.3 million expectations. So let's talk more about these earnings. It beats on the top and the bottom line. Erste Group Bank CFO Stefan joins me now. First of all, just give us your assessment of the quarter and the fact that you beat on this top and bottom line, and yet you still see the NII prospects for the year to be stable.
Yeah, good morning from Vienna. We are very happy that on the basis of a strong first half year results, we are able to substantially upgrade our guidance for the full year 2024. And equally so, you mentioned it, can announce a very attractive dividend prospect for the year 2024. I think the basis for the successful first half year was a good combination of strong NII income, especially from Central Eastern Europe, and strategically we are pushing up our fee income, and this in combination with good cost discipline resulted in a very, very strong operating result. Asset quality keeps on being very, very solid, and on that, then the bottom line has been developing beyond our own expectations, to be honest.
And of course, we talk about the beginning of a global easing cycle. What needs to be done to increase your margins, perhaps on the lending side, to offset some of the pressures that are going to come through from lower interest rates?
Well, when it comes to net interest margins, we have been talking to the market already since Q3 2023 that probably the peak has been seen, and now we are very stable in the area of 2.4 to 2.5%. We are very optimistic that we can keep it at similar levels for a while, and with growing volumes, we should be delivering a stable net interest income for this year, and then going into 2025, we are more optimistic for the macro picture in our region, and that should support the operating environment.
Yeah, speaking about the macro picture in the region, there's been a lot of concern expressed about the state of the real estate market, commercial real estate within Austria, also some concerns expressed by the ECB as well. Can you just give us your perception of how things are evolving on the ground and how you're provisioning for a potential uptick in the cost of risk?
Yeah, very important point. I think we have to distinguish very clearly here between let's say, the German market, Western European market, also partially Austria, I agree with you, and the Central Eastern European market. In Central Eastern Europe, not only in the area of real estate, but in general, asset quality has been excellent. So absolutely no issues there, no whatsoever kind of provisionings necessary. In the Austrian market, on the back of a very weak German market in some special cases, we had a couple of provisionings, especially in the savings bank sector, but very much under control. And we don't see needs for further provisioning, maybe even to the contrary. Therefore, we are upgrading our risk guidance to less than 20 basis points, which I think, historically speaking, is an excellent number.
Well, we talked about you increasing the dividend. I just want to ask you whether you're going to keep any money to play with, so to speak, to pursue M&A strategy. And analysts point out that one of the countries in Central Eastern Europe that you don't have a footprint in is Poland. What is your strategy from the M&A side, and are you thinking of expanding geographically?
Well, first of all, the increased dividend that we are indicating for the year 2024 is not limiting us in any form in our ambitions to grow organically, but also potentially inorganically if interesting options are offered. On the one hand, we are fully committed to the consolidation within our existing geographies, and we have been active there in recent years, and I'm relatively sure that opportunities will arise also in the forthcoming quarters. Yes, Poland is an area that we are looking at. It's of course not an easy market to enter, but we have the feeling that the M&A market overall in the European banking area might be picking up, and will definitely be part of these activities.
And broadly, how are you seeing the competitive landscape within CEE right now, Central Eastern European countries?
I would keep it very short here. It hasn't changed too much recently. I think the strong players there are well known. We are definitely one of them, and not too many shifts. Some colleagues have been readjusting, so to say, their footprint, but overall the competitive landscape has been reasonably stable.
Perfect. Sir, thank you so much for your thoughts today. Erste Group CFO Stefan Dorfler. Well, we're getting more earnings come through, this time from Engie, French utility. And just to give you the headlines there, they have raised their 2024 recurring net EBIT, ex-nuclear guidance, to at 3.8 billion euros for the first half. That is actually a small decline year on year, but the guidance for all of 2024 has actually been increased. And just to give you some more commentary as well, recurring net is to come through at 5 billion to 5.6 billion. This is higher than the estimates of 4.56. So that upward revision for the 2024 calendar year is likely to be a key driver. Just some commentary from the CEO, UK's Electricity Northwest process they see as an opportunity. However, they're not ready to overpay for power infrastructure. That is from Angie. All right, plenty more coming up. This is Bloomberg. Welcome back, everybody. Well, with all the earnings that are crossing, we could forget that there's NFP coming up later today, but we will not. Let's take a look at what the market is penciling in for this all-important U.S. jobs data that is coming through. The expectation is that we're likely to see a moderation in terms of the headline print from last month's 201K. The analyst community is settling around a 175K print, so a slight moderation to come through. Unemployment rate expected to hold steady at around 4.1%, though, of course, the market is pretty much 100% priced in now for a September rate cut out of the Fed. So keep an eye on that labor market data and how it's going to influence Fed pricing expectations. But also keep an eye on data more broadly. Look at the picture for how U.S. economic data has come through versus expectations. U.S. economic data misses. The surprise index is near its lowest level since 2015. And that is really just reinforcing the fact that many people have now started to become really concerned about the data that's coming through from the U.S. ISM data yesterday. Another case in point, disappointing to the downside. The ISM employment index also missing by the most since post-COVID times. So something to watch out for there as we head into the U.S. session. But of course, the major sell-off continued overnight. We're seeing some big moves out of the Nikkei, declines of almost 5% in the handover from the Japanese index. All of this in retaliation to the Bank of Japan hike earlier this week. As you can see on the board, 5.8% lower now for the Nikkei. We're down more than 10% from the highs that we got to mid-July. And coming up at 7:30 a.m. UK time, we're going to be speaking to the CEO of the UK's largest long-term savings and retirement business on their new venture into private markets. That is Andy Briggs. But the opening trade is up next. This is Bloomberg.